All right, today we are diving deep into a really powerful investment strategy, one that's called volatility targeting. We're going to break down exactly how it works, look at the actual evidence, and figure out if it can really smooth out that crazy, chaotic ride we call the market. So let's get right into it. You know that feeling, right? That pit in your stomach when the market just plummets, or that nervous energy when a rally just feels a little too good to be true. We've all been there. But what if the goal wasn't just to, hang on for dear life? What if you could actually tune your portfolio's sensitivity to those swings? What if you could control the ride? So here's our game plan. First, we're going to talk about the real problem with volatility for us investors. Then we'll get into this idea of targeting it directly, check out the tools you need for the job, and then the big one, we'll see if it actually works with real data before we touch on a few more advanced ideas. Okay, before we jump into the solution, we've got to be crystal clear on what the problem is. For most of us, the hardest part isn't just picking winners, it's surviving all their wild, unpredictable swings. Think about it for a second. All the financial news, it's totally obsessed with finding the next Apple or the next big thing. But honestly, the silent killer of our long-term returns is getting spooked and shaken out of a perfectly good investment during a market panic. Surviving those violent swings, that is the real game we gotta master. And the fancy term for all these market swings is volatility. But it's not some kind of dark magic. It's actually a statistical thing you can measure. So really, when we're talking about volatility, we are just talking about risk. And hey, if you can measure something, you can start to manage it. And that right there, that brings us to this huge shift in thinking. Instead of just taking whatever risk the market decides to throw at you each day, what if you decided on a risk level you were comfortable with and just tried to stick to it day in and day out? This quote from the research platform Quantipedia, it just nails it. The goal isn't to chase the highest returns no matter what. No, the goal is to keep the portfolio's risk levels stable and consistent, right around a number that you've chosen. This chart just lays out the difference perfectly. On one side, you've got traditional investing. It's all about a fixed dollar allocation. Think of a classic 60-40 portfolio. Your dollar amounts are set, right? But your risk level? Oh, that swings all over the place. Volatility targeting completely flips that script. The goal is a fixed risk allocation. Your dollar exposure actually changes, up or down, specifically to keep your overall risk profile stable. So how in the world does this actually work? What are the nuts and bolts of it? Let's pop open the toolkit and take a look. The best way to think about this is like an advanced cruise control for your investments. When the road ahead gets really bumpy and dangerous, meaning volatility is high, it automatically eases off the gas. But when the road is smooth and clear, low volatility, it presses down on the accelerator to make up for lost time. So the whole process really boils down into 4 pretty simple steps. First, you measure how risky the market is right now. Second, you compare that to your personal target. If volatility is way too high, you dial back your exposure, you sell. If it's too low, you ramp up your exposure, you buy. It's this constant, dynamic process of adjustment. Now, that first step, measuring volatility, it's super important. The simple way is kind of like the tortoise in the race. It looks at all the past data equally, so it's really slow to react. But a much smarter method, called an exponentially weighted moving average, or EWMA, well, that's the hare. It gives more weight to what's happening right now, and that makes it way faster to respond when market conditions suddenly change, which is exactly what you want for a strategy like this. Okay, so that's all the theory. But the real question, the million-dollar question, is, does this stuff actually work in the real world? Let's look at the data. So here it is, a direct comparison from Quantpedia's research looking at a 14-year period. On one side, a standard 60-40 portfolio. On the other, the same portfolio using volatility targeting. And the results, they're pretty stunning. The targeted portfolio delivered a higher annual return with lower risk. Let me say that again, more profit with less risk. Now, a really important metric here is the Sharpe ratio. It basically measures how much return you're getting for the amount of risk you take. Higher is always better. And look at this. The volatility targeted portfolio Sharpe ratio is way higher, 1.34 compared to just 0.90. It means you're getting a lot more bang for your risk buck. But honestly, for a lot of us, this is the most important number on the whole screen, the maximum drawdown. This is the absolute worst case loss you would have felt from the peak to the bottom. The standard portfolio, it lost almost a third of its value at its worst point. Ouch. The volatility targeted one, it cut that loss almost in half, down to less than 19%. That's a whole lot less pain during a crash. Now, it's super important to know this isn't some magic wand you can wave over everything. The research is pretty clear that this strategy has the biggest, most positive impact on risk assets, like stocks. But for other things, like bonds or commodities, the effect is pretty minimal. So it's really a tool that's best suited for managing your equity risk. Okay, so we've covered the main idea, and we've seen the evidence. Now let's just quickly touch on a few more advanced concepts that kind of build on this foundation. I mean, this is a topic you can go really deep on. For instance, some research looks into the volatility effect, this weird finding that less risky stocks often give you better risk-adjusted returns. Others say it's even more powerful if you only focus on downside volatility, just the scary drops. And funnily enough, sometimes the best results come from just mixing things up, like doing a simple 50-50 split between a standard portfolio and a volatility-targeted one. And this leads to the obvious question, right? If you can get higher returns with less risk, that sounds like a free lunch. So why on earth does this opportunity, this volatility anomaly, even exist? Well, the research points to a few main reasons. First, a lot of investors just can't use leverage, which you sometimes need to boost returns when volatility is super low. Second, you've got career risk for the pros. It's often safer for a fund manager to just copy the index. And finally, there's us, our own behavioral biases. We get all excited about those high-risk lottery ticket stocks, and we end up overpaying for them. And listen, this isn't just some wacky theory from an old academic paper. This strategy is being used right now, in the real world, by some of the biggest names in the business. Morgan Stanley, for example, straight up uses a risk-controlled framework in some of their big global strategies, constantly adjusting their mix of assets to keep a stable risk profile. So if you're going to walk away with just one single idea from all of this, let it be this one. Maybe the goal of investing shouldn't just be about finding the next winning stock. Maybe the more durable, the more robust strategy is to shift our focus to actively and intentionally managing the one thing we can actually control, our exposure to risk. And that leaves us with one last big idea to chew on. Traditional investing thinks about assets as things you buy, stocks, bonds, property. But what if risk itself is the new asset class? If we can target it and measure it and manage it directly, what does that really mean for the future of how we all build our portfolios?